All right, welcome to this executive explainer briefing. Listen, if you're a financial advisor and you're managing client portfolios that have literally any degree of digital asset exposure, well, you know this past week has been an absolute masterclass in extreme market mechanics. We're stepping in today to conduct a really thorough autopsy of this massive, violent market sell-off that we've all just experienced. But we're not just going to sit here and look backward. We are providing a forward-looking, highly actionable roadmap for managing your portfolio exposure moving forward. The market structure has fundamentally shifted, and navigating this kind of fallout, it requires precision, not panic. So let's dive right in. Now, as professionals, we need structure. So here's our roadmap for the briefing. First, we'll do the autopsy of the market wipeout. Second, we're unpacking the macro catalyst. Third, assessing the TradFi contagion. Fourth, we'll give you a strict technical watch list. And finally, a masterclass on risk systems. We are moving logically from a high-level macro crash analysis directly down to granular, actionable asset strategies. Okay, section 1, the autopsy, market wipeout. Let's start right at the scene of the crash. I want you to think about the sheer velocity of capital destruction we just witnessed. $390 billion, just gone. A total market wipeout that dragged the entire crypto market capitalization down to $2.11 trillion in a matter of days. We saw Bitcoin crashing down to a 4-month low, sitting roughly 18% down, which honestly completely stunned the broader market. Now, as an advisor, seeing $1/3 trillion just evaporate this quickly is a stark, unavoidable reminder of the truly unique volatility profile of this asset class. It's intense. But you know what? That top-line number only tells half the story. The real story is the $7 billion figure right here. More critically, $7 billion in leveraged positions were literally vaporized. And keep in mind, that wasn't spread out over some prolonged grinding bear market. Over $1 billion of that was wiped out in a single brutal 24-hour window. Leverage was utterly punished. So as a fiduciary, the absolute primary question you need to be asking yourself right now isn't just why the initial drop happened. The question is whether this specific, violent mechanical selling is actually over. Are we looking at a market that has finally found its fair value, or are we still just trying to catch a falling knife? Let's move to section 2. Macro catalysts. Because to properly diagnose this, we have to look under the hood. To really answer that question about fair value, we need to unpack the underlying triggers. It was exactly 3 simultaneous forces that collided to break the market's back here. Force number 1 was an initial geopolitical shock. Specifically, ongoing tensions and the US-Iran conflict drove a massive surge in crude oil prices. And obviously, that fueled massive secondary inflationary pressure across everything: corporate transportation, production costs, you name it. Then, force number 2, that inflation collided with a scorchingly hot May jobs report. We're talking 172,000 new positions created, which was more than double what economists were forecasting. Now, normally, lots of jobs, that's great. But in our current liquidity environment, it totally eliminated any lingering hopes for Federal Reserve interest rate cuts. And then, force number 3, a major institutional player triggered a massive Bitcoin sell-off. This initial drop broke key support levels, which triggered automatic stop losses, and that initiated the massive leverage unwind we just talked about. Which brings us to perhaps the core lesson for this week's post-mortem, and that's the concept of mechanical selling. During a leverage unwind, mechanical selling completely and totally ignores fundamental value. Prices don't just fall to a fair value and neatly stop. They violently overshoot because forced liquidations are entirely blind. They don't care about the underlying asset. The key narrative you have to understand here is distinguishing between an asset dropping because it fundamentally lost value versus an asset plummeting purely due to a cascading wave of mechanical selling. Listen, if you're out there catching knives during a cascade without waiting for structural confirmation, you are flat out gambling with your client's capital, not trading.
All right, section 3, TradFi contagion. We've got to zoom out a bit here.
Because a massive takeaway from this week is that this isn't merely an isolated crypto problem. It's a broader macroeconomic liquidity problem that demands your full attention. Look at this 80% metric. Crypto is currently demonstrating an 80% correlation with the S&P 500. Overall market sentiment has violently shifted from a cautious bullish bias straight into extreme fear, and digital assets and traditional equities are moving in absolute lockstep. The old popular narrative of crypto acting as this pristine, uncorrelated inflation hedge, that is completely off the table in the current environment. Bitcoin and Ethereum were dragged down in perfect parallel synchronization with broader market indices. But when we contrast traditional finance and crypto, the major difference lies in the magnitude of the reaction, which comes down to market structure. Traditional equities simply sold off on hawkish Fed fears. It was a standard, relatively orderly repricing of risk based on the reality of higher for longer interest rates. But take that exact same macro pressure, apply it to the hyper-leveraged crypto markets, and it triggers extreme fear and a complete structural collapse. But simply, TradFi gets a haircut, over-leveraged crypto gets liquidated. As a portfolio manager, grasping this structural distinction is absolutely essential when you're calculating your risk-adjusted returns for digital assets going forward. Let's dive into Section 4, the technical watch list. Now that we know what happened and why, let's look at the actual numbers. Keep this critical support watch list right on your desk this week. Bitcoin is the undisputed battleground right now. It's currently chopping around and testing the deeply critical February baseline at roughly $60,951. It's trying to steady the ship, but listen closely. If that 60K psychological level gives way on high daily volume, the downside void is massive. Then looking at Ethereum, it shed roughly 20% to bottom out at $1,609, and is currently staging a very, very weak bounce. And you know the saying, when the king bleeds, the kingdom burns. Altcoins saw catastrophic losses. Solana took a brutal plunge, outright losing its critical $70 support mark. Meanwhile, XRP is showing marginal relative strength, holding pretty precariously at $1.11, but a break there guarantees a rapid descent. I also want to take a second to address a community spotlight question we saw regarding Binance Coin, or BNB. An investor was asking if BNB is safe to accumulate now that it briefly fell below $600. The hard analytical truth? Absolutely no asset is safe during a cascading liquidation event. Losing that $600 handle signifies real structural weakness. For anyone looking at large caps like BNB slipping under their bases, you have to understand this. Blindly dollar cost averaging heavily right now carries immense uncompensated risk until Bitcoin establishes a true floor. Large cap altcoins are heavily, if not entirely, dependent on Bitcoin printing a higher low first. You can't front run the king. And that brings us to Section 5, Masterclass, Risk Systems. This is how we survive and protect capital. This checklist is literally how professionals survive regimes like this. When hundreds of millions are being wiped out daily, standard mean reverting indicators like RSI and MACD, there are entirely useless. They will tell you an asset is oversold the entire way down to zero. Systematic traders survive these events by drastically altering their position sizing. You need to cut your standard risk per trade in half. Why? Because your stop losses need to be significantly wider just to survive the violent volatility chop without getting stopped out randomly. Instead of traditional charting, you have to utilize liquidation heat maps. You need to map out exactly where the borrowed money is sitting and where those algorithmic stops are clustered. And above all else, you wait for structural confirmation. Which brings us to the ultimate unbreakable macro overlay rule. Do not fight the Fed. With the job market running this hot, interest rates are going to remain elevated. You just cannot blindly buy technical dips in the crypto market when broader macroeconomic liquidity is actively tightening up. Your crypto technical analysis has to be strictly overlaid with this macro reality. If liquidity is leaving the global system, it is going to aggressively leave the highest risk digital assets first. It's just a fact. So the absolute most vital question you must ask yourself right now, especially as a fiduciary managing other people's money, is this. Is your strategy actually built on patience, structural confirmation, and hard data, or are you operating on emotion, forced action, and essentially gambling on catching a falling knife? In market environments exactly like this one, doing nothing is often the most profitable, or at the very least, the most protective, active decision you can possibly make. Patience pays off, everyone. $2 trillion have been wiped from the broader market capitalization peak, and the weak hands have been violently shaken out. Keep your powder dry. Let the dust settle. Let the algorithmic liquidations completely clear out the over-leveraged gamblers from the system before you even start looking for re-entry points. Remember, preserving your client's capital is your ultimate priority. As an advisor, protecting the downside during these massive structural breaks is exactly what defines long-term portfolio success. So as we watch Bitcoin test that deeply critical 60K battleground over the coming days, I want to leave you with one final provocative question. When the dust finally settles on this wipeout, will your portfolio be properly positioned to capitalize on the recovery, or will you be stuck busy trying to recover from unforced errors? Stay sharp out there, trust your systems, and keep a very close eye on those levels.